The Fed's impact is loud and clear in currencies and rate markets too. The rupee has crossed 85 per dollar as expected, and currencies across Asia are down between 15 basis and 75 basis points just today, between 0.5% and 3 percentage points. Only for the month of December, Indian yields have gone up by 10 basis points in December alone, today by about 3-4 basis points, with the US yields jumping beyond 4.5 for the 10-year. The Reserve Bank, this rise in yields in India is happening despite Reserve Bank cutting the CRR and widely expected to cut repo rates as well in its next meeting in February. But how does the Fed change the Reserve Bank's plans? How does it impact currencies, rupee? Mitul Kotecha, head of FX and EM Macro Strategy Asia at Barclays, and Neeraj, Gambhir, Group Executive Head Treasury Markets and Wholesale Banking Products at Axis Bank, join us. Mitul, Neeraj, thank you very much indeed for your time for what would be a busy morning at your own trading desks. Mitul, first up, how do we interpret this? I mean, 108 on the dollar index. I read your report of day before yesterday. I'm not quoting it, but you had already written that 107 is not the highest for the dollar index. It's gone to 108. Have we seen the worst, or, can we see the dollar rising even more?
I think the answer to that question is we can see the dollar rising more. Our view is that there is clearly going into next year more upside risk. I know we've had this knee-jerk reaction of the dollar to the Fed. But that said, next year in January, we have a very big event, the inauguration of President-elect Trump, and potentially very significant tariffs placed on China and the rest of the world. And the U.S. economy continues to outperform from a growth perspective. China's economy is still fairly weak. The rest of the world is still flagging in terms of its growth. So all of that seems to show that the U.S. is attracting capital from elsewhere, and that means the dollar upside continues to see momentum here. So while it's not going to be a straight line dollar appreciation, we do, and again, a lot will depend on Trump's policies. We do think the direction of travel is still for a higher US dollar into the first half of next year.
Thanks, Dan. And what about yields, Mitul? This 4.5 was not expected. Many people, of course, expected that the Fed will tone down rate cuts next year. 2 was definitely not. 4 getting reduced to 2 by the FOMC's dot plot was perhaps not in the price. But 4.5 on the 10-year, where do we go from here?
It does feel like the market's gone too far in terms of yields. And really, if you look what's being priced in for a terminal rate now, it looks a little high. It seems, in our view, that even 10-year yields have probably backed up a lot in the current range. We were looking at a 4.25%, 4.5% range. Look, I think the Fed has moved into line with our view for next year, that we expect 2 cuts next year. And the dot plots now are showing that. But I think there is still room, ultimately, for the interest rates in the US to continue to decline gradually. The labor market is starting to loosen up a little bit now. Inflation, although it has been a bit sticky, is moving lower in the US and to the Fed's target. So there shouldn't be much really in the way of further reduction in rates. So I think this move in interest rates appears to be a little bit more aggressive, and it's a knee-jerk reaction. Our interest rate strategists have actually taken the opposite view. They've gone long 1-year, 2-year US rates, and of the view that market is a little bit too hawkish in terms of what they're pricing.
Okay, I guess the market is also staring at this potential government shutdown, considering the tweets that are coming from Elon Musk and to some extent even from President Trump. And therefore, perhaps worries about the fiscal deficit going overboard. But Neeraj, this makes the Reserve Bank's position a little tough. I mean, let's assume for argument's sake that the 4.5 continues when the RBI meets in February. They will already have had the Jan 20 inauguration. So, does this change the position in terms of the expected rate cut?
So if you look at the Fed policy, I think there are three things that the RBI would want to focus on. One is obviously growth. We've had much slower growth as compared to expectations. The second is currency. I think currency is clearly weak, although rupee continues to be one of the strongest currencies on a relative terms as compared to even currencies like Singapore dollar and Indonesian rupiah. So while currency is weak, there is pressure on the currency, but Reserve Bank continues to manage the volatility in the market. And third, obviously, is the overall inflation outlook. We've had stronger than expected inflation in some senses. Food and vegetable price inflation continues to exert upward pressure. And between now and February, we'll need to see how each of these three variables actually play out. We should see some normalization on growth as the government spending has kicked in and as the Reserve Bank has actually induced more liquidity into the system. On inflation front, I think the key driver will be what happens to the food and vegetable prices. So far in December, there hasn't been much respite. So if the inflation print continues to be higher than what the market expects, then that is something which speaks against a potential rate cut in February. And obviously, as the dollar strength continues, the currency pressure will be there. So I think all in all, it is still a possibility that Reserve Bank might cut rates. So February is live in that sense. But I think the pressure on RBI to cut rates in February in some senses actually lessened to some extent as Fed has also backed off from its aggressive sort of rate cutting cycle in the next year. So I think a lot can change between now and February, but I think there is lesser pressure on Reserve Bank now to think of a rate cut at this point in time.
Okay, I'm not done with this line of questioning to you, but let me just get the view on the dollar rupee from Mitul. Mitul, it's taken a while for the rupee to cross 85 because of stiff resistance from the Reserve Bank. Where do you all see it now by year end? That's not too many days, but more importantly, by the fiscal year end, March end.
Right. So, I mean, we continue to see depreciation of the rupee. Our view has been that it's been, as you said, there's been aggressive intervention in recent months, and that's probably artificially stopped the currency from weakening to a more natural level. I agree that the rupee will outperform its peers in Asia, but that doesn't mean that we won't continue to depreciate. So, for example, we're forecasting 87 for dollar INR by end of next year, which, given the pace of the move in the dollar, I mean, obviously that forecast is on track as we currently speak. And I think ultimately there's a few factors here. We believe the rupee is rich on a valuation basis, both on a nominal and an effective exchange rate basis. We think we are focusing again on the yuan as a key factor here. If the yuan depreciates more significantly, which we think it may do, that could also exert downward pressure on the Indian rupee. And that trade deficit with China, of course, is quite important. So you've got that, the slowing in growth, the push for exports and manufacturing, and broadly a stronger dollar. So all of those factors play for a dollar rupee higher. The question is what pace. But we think the RBI will continue to control the pace of depreciation, but not stop it or reverse that depreciation trend.
Okay. No, they wouldn't do that. But they have come in for a lot of covert criticism. It's never overt on the RBI. Covert criticism on being unduly smoothing volatility to the disadvantage of even market participants. But Mitul, just very quickly, do you anticipate that the yuan will go all the way to 8? People have been calling in India for 7.3 like round the corner. It's only now that the yuan has gone to 7.29. Is 8 on your cards? And if yes, when?
Okay, so our forecast is 7.5, again, by end of next year. But we have to highlight the fact that there are risks of a much bigger depreciation of the yuan. Our models show that dollar yuan may even get above 840 if we see 60% tariffs on China and some retaliation. And again, this is not our forecast, but the reality is that what it does suggest is that there are still quite significant downside risks to the yuan. Look, if we do see 60% tariffs, it's very likely that we see some mitigating devaluation, depreciation of the Chinese currency. Again, the magnitude will really be dependent on to what extent President Trump inflicts tariffs on China.
Okay. Yeah. And there's widespread analysis that the 60% is only a bargaining tool. And I think Goldman Sachs has some model which says that 20% is perhaps the more realistic number. But 7.31, I believe, on the CNH, on the market rate on the CNY as we speak. Neeraj, two questions actually. First one, now the Reserve Bank has also to tackle imported inflation. If the rupee goes indeed towards, 87 as Mitul says, but, earlier 87 perhaps is year end. Even if it goes to 85.5, there is a fairly serious imported inflation. So will that prey on the Reserve Bank's decision? And what's your own rupee target?
So I think another maybe about 2 to 2.5% depreciation over the next 12 months is quite possible, which is pretty much in line with what Mitul has talked about. Yes, as rupee depreciates, there is a imported inflation or cost push inflation factor that comes into play. But I think that is, in some senses, less relevant in the current context. I think what is more relevant in the current context is how much disinflation do we see in the vegetable and food prices? Because remember, the core inflation in India still continues to be close to 4% or slightly below 4%. So that's not a real worry at this point in time. I think what's giving the inflation its upward trajectory is the fact that food prices and some of the edible oil prices and those kind of prices have actually been on the higher trajectory. Yes, weaker rupee means higher, prices for edible oils, imported edible oils, etc. But I think all in all, it is the overall food complex inflation which will determine the trend of inflation going forward and whether Reserve Bank feels comfortable, with the trajectory of the inflation.
Okay. 2.5 is how much in dollar rupee? You're looking at 85.50?
Basically you can say that whatever is the implied forward rate currently, the forwards are trading at about, 2% or thereabouts. I think so, or slightly higher than that. So I think that's the level of depreciation we should expect. So effectively the forward curve gets realized.
Okay, so effectively probably 86 is very much round the corner, 87 a distance away. Now that is the big message I want to give viewers, that we are looking at a rupee very, very different color. 86 and 87 is freely being forecast both by the forward market and by analysts, and I want to get that message across to everyone. Mitul, Neeraj, I know we have just warmed up. We have to have a more detailed discussion on currencies and rates on a later day. Thank you very much indeed for your time. But do remember, there is also an expected Chinese dumping because they will not be able to enter US markets. Will that impact inflation? There are lots of issues to discuss over here, but that's on another day. Wrap up on Bazaar on the note that it's a very tense morning, both for equities and for currencies and fixed income. After a break, Chartbusters will take the action for.